All right. Hello, everyone, and good morning. Thank you for joining us here at EMG. Our marketing team works very diligently to bring in a lot of wonderful subjects and educational material for you to expand your practice and your use within the insurance product space with all of our amazing carriers. So today we have Nationwide here. We were discussing, if you do have questions as we go through, we're going to ask you to put them all in the Q&A at the bottom of the screen there. We'll hold the questions until the end in case our speakers cover something that you're asking. And then at the end too, we do have a smaller group here today, so we could, if you want to talk back and forth with our host today, we can unmute you and we can have a follow-up conversation at the end. So we'll go ahead and get started. I'm going to introduce Cody and Alyssa with Nationwide to kick us off.
Thank you, Elizabeth. Good morning, everyone. I'm Melissa Dela Cruz. I work on our CareMatters wholesaling team at Nationwide, and we're really excited to be able to deliver you our newest solution in our suite of CareMatters, and it is our joint option. We are the first in this marketplace in a cash indemnity format. So there's really only 2 carriers out here. So if you love our cash indemnity solution or your clients like to have the control of their benefits and how they utilize it, this is a great solution to look at. If you've already known Nationwide and love how we run our solutions, it's going to have that similar feel, except now you have the ability to do 2 insureds onto 1 contract and get that savings. That's really that goal of the product. This launched about a month ago, mid-June. So it's been out almost 2 months now, and it's been pretty popular as an option. So we're glad to be able to deliver this for you. So we'll go over a lot of the highlights of what's new for CareMatters Together. But if this is your first time looking at long-term care or you're not 100% sure, I always like to give you a little bit of information on that as well. And please type in the questions that you do have. And it doesn't have to necessarily just pertain to the product that I'm showing you today. It could be just long-term care in general. That is our goal. We want you to feel comfortable with not only this solution, but long-term care. It's near and dear to my heart. I feel that it is something that is severely lacking in the marketplace for our clients to plan for. And it is such an important need, and that can make a difference not only in their lives, but that of their loved ones. So with that being said, let's take a look at some of the things I think are going to be really important when you're having these conversations. Long-term care in a lot of clients' minds, it's not generally something anybody wants to think about, needing extra help as we get older. And I think if you've dealt with any loved ones older, you know how much independence is important to them. But this is just as an important event to plan for, just like they've been planning for retirement. This is an event. It is not necessarily a place. Sometimes our clients will think of long-term care as a place and really thinking of it as, oh, nursing home. I'm planning to go into a nursing home. And that's definitely far from it. It is an event that you're planning for and trying to get ahead of it before you have to plan in a reactive mode. And that's our goal. Is just like retirement, you want to know what income's coming in. You want to plan for long-term care. If that's that case, where's that income coming from? Can I have a income stream set up for this and plan for this financially? Just like anything else, that's just an important aspect of that retirement planning, and usually a missing part of the puzzle. I think generally in the United States, they say maybe 10% of individuals, if we're really lucky, have some form of a long-term care plan. And if that includes insurance, is obviously a little bit different, might be in the single digits at that point. When you are planning for long-term care, really what this is doing is being able to provide an income stream that covers the ability for a lot of individuals, which is really important, to stay at home. And obviously that can shift. Not everybody necessarily feels that they may want to stay home. Maybe they're comfortable and rather go into facility care or assisted living, anything of that nature. It's being able to have an income stream to do that and make that more suitable, and know whatever your plan is that goal. And it's also making that plan ahead of time when you are in a state of mind of clarity, is what I would say. Because sometimes when you are in those situations, you might get a little scared and you don't know what that plan is and you are reacting there. Knowing that you have some kind of plan can make that big difference. It helps maintain that lifestyle of maybe that healthy spouse, especially if they may be part of that caregiving situation. If they're going to provide some of that care, it can give them the ability to have funds to get relief and hire someone in sometimes a couple times a week, so they aren't taking that on entirety 24/7. ability to pay for informal care, professional care, if that's what you would like, preserves that retirement income. That's one of the biggest ones. Sometimes people will say, I'm already planning for retirement, and this is, I will use my income from that to plan for long-term care, when reality is that income that you're planning for really covers just a generic of your expenses that you have on a day-to-day basis. When you're thinking of, hey, I might maybe at minimum need $6,000 a month, maybe $10,000 a month for long-term care expenses, that can definitely dip into that retirement income you plan for on a monthly basis and say, well, is that enough if you had that coming out? Is that enough to maintain the lifestyle for your spouse or the things that you do want to achieve? And sometimes having those questions does bring that up and say, well, yeah, I didn't really plan that it was going to be that expensive. And then preserve, obviously, the assets that they've already planned for their own legacies. And sometimes it's hey, you could absolutely take everything out of your assets, plan for long-term care, but if you could plan ahead and take a sliver of that to protect everything, so it didn't all go to that cost, that can make a big difference for somebody. So what makes CareMatters Together different is obviously we're going to be the first cash indemnity joint life linked benefit solution out there. So if you have seen that and we're really looking for that, this is a fantastic product to look at that. It is cost effective. That's really, you can still use our individual policies if somebody wants their own policy. This is just a way to look at it is if you were already going to insure two people, a couple, for example, is probably obviously the most common one, a married couple or a couple. This gives them that ability of, hey, if you were going to already do two policies, this can save you a couple of $1,000s, even more, depending on payment structure, to be able to do this on one policy. That's going to be that biggest difference there. We're looking for more simplicity here. You have the option, it is a shared pool, so it is going to look different to what you're used to, where you may have seen 2 to 7 years of coverage. You have 48 months, 72, or 96 months that is shared. The pool is shared, 96 months, but you each have your own monthly benefit that you can utilize, and it can go into any kind of scenario you want to. There isn't a specific amount that has to be left for one person to utilize. So you have that flexibility, is your choice as the owner of that contract to say, hey, how do I want this to work? Do I want to leave some for the second spouse, or do I have other assets if one's really needing all of that so that they can use the full policy, or 72 months or 96 months, whatever it may be? It's your control. So it could work out something like this. All the examples I'll show you are 96 months. So we have a couple here. Monroe goes on claim. He goes on claim for 2 years, which is pretty common for a male, that it may last around 2 years. Maybe he passes away at that point. Dolores doesn't go on claim till 4 years later, well, 4 years from the start of his claim. In that sense, she has 72 payments to utilize. So maybe it was $10,000 a month. Monroe got 24 months of $10,000 a month. And then when Dolores goes on claim, she still gets $10,000 a month. She just has 72 months left over in that policy. Or it can overlap. So we can cover same-sex couples. We can cover, maybe it is siblings living together. They're not married. They're just, they're older and that's what they're doing. They're going to share those expenses. You could do that. Business partners, maybe father and son. As long as there's an insurable interest, then we can go ahead and do that, and that there's no more than a 25-year age gap as well. So in this case, you can overlap claim. Steve goes on claim for 42 months, 2 years into that claim. Then Michael goes on claim and uses the last 54 months. So in that case, those two equal the 96 months. Or like I mentioned, one person can use the entirety of that contract. And this can come up in a couple of scenarios. It could be that Lori already had a policy. Maybe she did our individual policy because she was insurable. This product does take on more risk for somebody that's maybe not as healthy from our individual policies, or the individual policies that you see out there in many cases. So in this case, maybe John could never have gotten long-term care beforehand. Lori already has a policy. So this is really going to be, hey, I'm going to be on this contract, but this is really John's policy if he needs long-term care. If he doesn't, then I can utilize it. But in this case, he goes on claim, he uses the full 96 months. Anything that isn't utilized on the monthly basis, they could be saving for a more expensive month, or maybe they were really using half of that benefit the whole time and they were saving it in a savings account. Then that can be something Lori can dip into when she needs her own kind of care but it's out of the policy. So that's really the power of cash indemnity, is you're going to get that full payment unless you tell us you don't want it. Save what you don't utilize. It's out of the policy for you to use when expenses go up. Or if you just want to save it, and if you never get to it, then it's out of the policy for you to use for your own care or for other things that may come up, like maybe huge home modifications, new vehicles you might need for wheelchairs, whatever it may be. In the sense of predictability, we still want to make sure we give you the things that you're used to, and seeing with our CareMatters suite of solutions, guaranteed premiums, nothing's changing here. So you know exactly what you're paying for. We're not coming back to say, hey, this is going to cost more down the road. Your premium stays the same. Guaranteed benefits, guaranteed death benefit, and that accumulation of those long-term care benefits continue to grow. So if you have inflation, things of that nature, it's going to continue to grow. Even if you're on claim, it does not stop unless you've chosen a duration of, hey, I only want inflation for the 20 years, which I'll show you in just a moment. We did touch upon this a little bit, but the biggest difference in cash indemnity is you don't have to submit receipts. You're not having to get things approved so you can get reimbursed. I think there's a place in this when planning for long-term care for both of these solutions, but it's a matter of what your client prefers. If they prefer and feel comfortable with collecting receipts, then maybe that's where reimbursement makes sense. But if they want that control and not have to manage that, and be able to use their benefits for things that may not be what you would traditionally think is traditional long-term care costs, like someone mowing your grass, someone to clean your pool, pick up groceries, those aren't typical things that pop up in general, but they are costs that do make a difference in long-term care. Those are things I may not be able to do that I have to hire out to stay in my home that still have to get done. Cash indemnity really provides that ability to have a lot of those things and cover those incidentals. Now I want to show you some of the key features that make this a little bit more unique and different, but also give you kind of those parameters that you might be thinking about. One being, when can I have this conversation? So your minimum issue age on this product is going to be 30, and that's similar to our individual policy. The max age is going to look a bit different. So 70 is that cutoff, and it isn't necessarily the day you turn 70, as long as you haven't turned 71, and it is current age, is not age nearest. So, and that's going to be on the oldest individual as well. So you can't have somebody that's 71 and the younger person be 68. That wouldn't work. It's still, the oldest person cannot be beyond 70. And then it also depends on the payment option. So if you could still cover a 70-year-old, but they can only do a single pay, 5 pay, or 10 pay. For the pay to 100 or the 20 pay, 65 years old is that cutoff for that option. So that is new to us as well, is the 20 pay. So this will be new, and that obviously makes that more of an option, especially for the clients that you're talking to in that more common age that this conversation comes up in, mid-50s, 50s, 60s as well. So you have that option, but knowing that you have a range of ages and potential payment options makes this conversation more attainable than it ever has been before. I know that's always a hesitance for a lot of those conversations, is I can't do a single pay. Well, you absolutely could do a pay to 100 if you wanted to. And this looks very nice when you are looking at even traditional LTC policies. We've seen these look pretty similar in premium, that it makes a difference to have that conversation. So if that was something that you just had in your back pocket in the sense of, hey, they have a specific budget and we were going to look at traditional, even though we would love to have a death benefit and all these guarantees, that premium was outside of that, this is a perfect opportunity to look at this joint option and have all of those features and be able to offer that. In many cases, it could be exactly similar in premium, or maybe even just slightly a little bit more, but worth having that conversation. Like I mentioned, 25-year age gap when you're having this conversation, whether that's couples or you're looking at maybe mom and daughter getting on a policy, that's going to be that age gap. I'm going to touch underwriting in just a second, but if one of them ends up at standard, that gap drops to 10 years. So we have preferred and standard. It's going to look different. I don't want to spend too much time on underwriting, but what I want you to know is preferred looks different than on this particular product than life insurance. Preferred really can take up to 4 tables of risk. So if you're used to our long-term care and getting it approved, that's probably where your client falls. But if you have somebody that wasn't maybe as healthy as before, or maybe getting declined, as an option, it's worth having that consideration and getting them pre-screened to see if they could fall under the standard risk class that can really go up to a table H in underwriting. The only caveat I would say is if you end up with somebody that you have two very unhealthy individuals and they end up with both standards, it's going to be a no offer. It's not a decline. We just don't have anywhere else to place them in our suite of options since this takes on the most risk health-wise. But also knowing that it's just a no offer, it's not a decline in that situation. So I always recommend to know if you've pre-screened them, if they are worth having that conversation to say, hey, are they at least one of them at least going to end up on that preferred side? Minimum product limits. This is a good one. And this is where I would say it helps you compete in that sense of traditional policies. When you are looking at or why you might look at this, the minimum starting benefit is $1,500 unless you end up in one of these states that you are looking at here that have a minimum for that state. So again, tailoring it so that you can really design something that works for that client. And the max starting point for a monthly benefit is $20,833. So you can still put inflation on that, but that's just the maximum we can start off in a LTC policy. Oh, I don't know how I ended up on that section. Let me get back over here. Here we go. So your premium payment options I already covered, but what I do want to talk to you about is something that is new to Nationwide is as long as one person is on claim, we will waive that premium going forward. So if you're looking at a 5-pay, 10-pay, or any of the other options outside of single pay, since you would have already paid the premium, if one of them goes on claim, those remaining premiums aren't due as long as that person stays on claim or one or the other insured is on claim. So that makes a big difference for somebody that might be looking at, especially like the 20-pay, pay to 100, where a claim could easily happen. As long as they're on claim, that premium is waived. They do not owe that premium back. So that makes a big difference for peace of mind of knowing for that client that they don't have to continue that premium if they're on claim. Inflation protection. So we still have no inflation if that makes sense for your client, but you still have your usual 3% compound and 5% compound. But what was added to this product to give you just another lever to pull on is 3% compound for 20 years. So it'll grow for those 20 years and then be locked in at that last rate at that given point. That can make a big difference maybe for somebody that is in their 60s. 20 years of inflation brings them right up into that 80 mark when an event could happen and they've had growth that entire time. That helps obviously in the sense of bringing that premium down or having that benefit start initially higher versus maybe 3% compound for life. I've seen that difference be in some cases $1,800 more as a starting point to do the 3% for 20 years versus life. So that can be just another lever again that you're able to pull upon to tailor that policy for your client. We will be the only one in this joint space that will actually offer a minimum death benefit. So basically what this means is even if they've used all their LTC dollars, they are still guaranteed to have some minimum death benefit for their beneficiaries. And usually that's going to be probably burial costs, things of that nature. It is 10% of that specified amount. So if your specified amount was $200,000, the beneficiaries are getting $20,000 to recoup any costs that they may have had at end of life or burial costs if maybe that wasn't necessarily already planned for. So that can make a big difference for someone to have $20,000 to work with. You still have potential tax advantages, just like CareMatters too. So if you haven't looked at this, this is a great opportunity. Many policies out there have this, but not all of them are built the same way or have this ability. So we're able to basically separately identify the premium that gives you that opportunity for tax deduction on the individual side or the business side. On the individual side, I will say it's a little bit harder just based on how the laws are written today, but that could obviously change, especially if you're doing a 20-pay, pay to 100. But if you have business owners that maybe it is their own business, they're an LLC, they're a C Corp, it's a family business, it's a great opportunity to bring this up because they can get those premiums deducted by purchasing it through their business, and it goes under an accident and health plan essentially. versus them having done it individually and maybe not being able to get that individual tax deduction. So it's a great opportunity to bring this up to your business owners. Now, my favorite feature is going to be this elimination period being retroactive. Each insured still has to make 90 calendar days of an elimination period to go on claim. So they fill out their claim paperwork. We wait 90 days to make sure whatever that event that is going on in their life is going to last at least 90 days. It isn't something like, hey, I broke my arm and that maybe that's going to recoup itself in 2 months. We're looking for a true need for long-term care. But if it is, hey, I have dementia, something like that, that's obviously going to last more than 90 days. It does not matter to us the kind of care they receive during that time. So if it is that a loved one's providing it, at that point, that's okay with us. They meet those 90 days, but we retroactively pay those benefits back. And that's really where that difference of a cash indemnity makes a difference. So if a loved one was providing that during that time, there probably wasn't a lot of cost that was occurring unless they wanted to pay that loved one. But with that being said, if my benefit was $10,000 a month, well, then I'm getting a check for $40,000 to recoup any costs that I had, and that's per insured, or it's an opportunity for me to put that aside, reinvest it, or save it for when costs may go up. I have a pool already built for that for, hey, maybe 6 months from now, I'm going to have a big expense because I need a new vehicle, or we need to move the bathroom from the second floor to the first floor. You have that access to that, and they're both entitled to that when they go on claim. So that makes a big difference for some individuals, because some policies out there, you still have to wait the 30 or 90 days, but you start from that point. You're not retroactively getting those benefits back. If you are working with clients that want to retire internationally, we can still use these policies to help them provide care outside of the US. It's just going to be a design choice that looks a little bit different. So when you do talk to us and you know that might be an option, let us know that that might be an opportunity, and we'll just design it a little bit differently so that we can make sure that they can get the maximum benefits outside of the United States. So generally would probably be our 48-month option that we would choose so that we can give them as much as possible. And in many cases, if you are looking at somebody that is going to retire internationally, chances are the care that they are going to get internationally might be on a more informal basis. So that's really where I can see cash indemnity really shine in comparison to a reimbursement. Obviously, if they can't find facility care, that's what they are looking for outside of the country, then that might be, they might have both options that they might want to consider. But in many of those cases, it might be family that's taking on that, or it's a more informal giver in their community that's providing it. The last thing I want to leave it up to discussion here before we answer some Q&A. So if you have those questions, make sure you're typing them in, is just how we process this from start to end. We want to help you with that pre-screen to make sure you have that opportunity before you take an application to know if your clients are healthy enough to qualify for these policies. But we don't stop there. We also want to make sure when a claim does happen that we are helping your clients through that process as well. They will be assigned a care manager when they go on claim. That person here at Nationwide will help them understand their benefits, fill out the claim paperwork, help them create a plan of care. So generally, if you have informal caregiving, or in many cases, if you have any kind of care, there is a plan of care that is created. If you get more formalized care, that facility might do that for you already. Essentially how that care should be provided, what kind of care you do need. But if you are doing it informally and having a loved one provide it, in general, you're not going to get that from your doctor. That's not something they usually do. Some cases in small communities, they might, but in many of those cases, it's something that you need for a claim. And if you're doing it, hey, I'm going to take care of my husband, who's going to do this plan of care? Well, Nationwide will take on that and say, hey, we'll create this for you so that you have that. And we'll help you also find services in your community. We have a caregiver advocate that you can use as soon as you got this policy approved. So it doesn't even have to be just claims. So if you have loved ones dealing with this, you can give them access to caregiver advocate that helps them find care in their community versus just having to Google and say, hey, where is an assisted living in my facility? Which is fine. You can absolutely do that. But wouldn't it be nice to be able to say, hey, I have a dedicated a site that helps me, or talk to somebody that can say, I'm looking for assisted living or adult daycare in my community, and be able to really compare each of them and find different things, as well as resources as things that you might not even know to ask, or your clients wouldn't know. Like, how do I hire someone to come into my home? What kind of questions am I looking for? What kind of questions should I be asking facilities? Like, one of the ones that came up recently was, do you have doctors come into the nursing home, or do the patients actually have to leave to go to doctor's appointments, which can make a big difference to somebody that maybe has dementia, where if you're taking them out of their element can cause a lot of stress. So it might be important to know, does a doctor come in regularly? Is there a doctor in-house already there, or do they have to be taken to appointments outside of the facility? So we really want to make sure that we can provide you that full experience to make sure your clients are helped from beginning to end of their policies, so that they get the care that they deserve and find the benefits and services they're looking for. So with that being said, I know we have a few minutes. I'm going to see what questions we do have. But if you have any that you want to be unmuted, we can absolutely do that too. I know it's a little smaller group, so we might be able to unmute everybody.
Yeah, I think, so there are a couple of questions in the Q&A. Alyssa, if you want to address those. There was some.
Yeah. Do both insureds? Yeah, the first question from Christy, let's see, both insureds need to live in the same residence to be eligible. So in general, not for like the parent and adult. If you're looking at maybe couples that aren't married, obviously that might be something we do want to make sure that they live in the same household. But yeah, parent and child, that would make sense for them today not to necessarily live in the same household, but that might be, hey, I am going to be their caregiver potentially. So that's why I'm insuring them. So in that case, that would be fine. And then under the hybrid policy, which pays first, life or LTC? The life. So it'll take you, assuming you get preferred, it'll take you 36 months essentially to get through the life component of it before you go into the LTC portion of it, but it's all paid as LTC dollars for you. And I will say, I did not mention this, when you have inflation, it's on the entirety of that contract. So I know that's not necessarily something you may see out there on the joint contract space. You're getting inflation the entire time. You're not paying to have inflation on the life portion of it. You're getting that inflated amount the entire time. And then what is the process for pre-screening if someone is insurable? Absolutely. So a couple of things, you can obviously reach out to your team, or you can reach out to us if you want to pre-screen them. We have, and I'll make sure we provide this to you all, that you have the guide. We have a pre-screen guide that goes through a lot of quick knockouts that will naturally just be knockouts, build charts, things like that. But it will also give you, if you prefer to talk to an underwriter yourself, a phone number and emails if you prefer either or to pre-screen that client. I prefer to call just so I can get all my questions answered same day. But if you have time, do the email. Don't provide anything identifying information. They're just going to look for, hey, this is a female, 49, give us the information, and they'll follow up with the questions that you may need. And you may only know, hey, they had breast cancer 5 years ago. They'll reply within 24 hours of that email to tell you, hey, did it reach their lymph nodes? What was the stage? What was the grade? What kind of treatment was it? Was it radiation? Was it a removal, and what type of removal if it was like breast cancer? So they'll help you through that process. And then, does the life portion have cash value? Yes, there is cash value. The goal of the product isn't going to be a growing cash value, but there is cash value. So if the client does want to surrender, there is a good chunk that they would be able to get back if they were looking at that. But there isn't necessarily a guaranteed return of premium. It is just whatever the cash value is. All right.
Right at 10:30. You are a hero.
Perfect. All right. Well, I think those were all our questions.
Yeah, I believe so. So keep an eye out for our email. So we did send out an email this morning with some material from Nationwide, from our marketing team, with a lot of different components of this. And then Alyssa, I was going to ask, would you possibly send over particularly some insight on the care assistance component, or
yeah,
you can send it, but if you can send that, we can. I don't believe we had that already, and I actually just got a question yesterday from an agent about that. So any insight you have for that, we would love to provide to everybody.
Absolutely. Yep, I will send you the caregiver advocate page, and we'll get that to you. There's one for you as advisors, but then there's also one that you can provide with the client.
All right, awesome. I just realized my camera wasn't on that whole time. Wow, that got weird. Okay. All right, everybody. And this was recorded, so if you missed any portion of it, we will have that up on our website here shortly. And thank you so much for joining us today. Thank you,
Thanks,
Nationwide, for helping host, and we appreciate all your insight.
Thank you, everyone.
Thanks all.
Thank you, Elizabeth.
Have a good day.